Okay, hello. I am Jason Shapiro with COT Market Report, and today I have the absolute pleasure of having Larry Williams join me for a conversation about markets and other things. And I don't know, for those of you who don't know who Larry Williams is, then I would argue you're probably in the wrong place. But Larry has been trading for a very long time. He famously won, the trading contest or whatever that thing is called. And I think to this day, no one's ever beat the return that he put up in the contest. What's even cooler to me is then his teenage daughter won the trading contest, which I think just speaks volumes. It's nice to have a teenage daughter just kick the crap out of all the rest of us. Larry has also written books about trading. He has developed indicators that are very famous, like the Williams percent R, things like that. He's dug deep into the COT stuff, which we'll definitely get into. I know he's very into cycle analysis, which is not something that I do, so I'd love to hear more about. I know he's a sentiment-driven guy, which I love. So hopefully we're going to have a very nice conversation. So welcome, Larry, and thanks for joining us.
Thank you, Jason. Look forward to it.
So let's start with a very broad stroke. How do we do this? How do we make money in the markets? What are the most important things to you?
Just buy low, sell high. That's all there is to it. That's all you got to do. It looks so easy. I mean, I remember when I first started in 1962, I asked somebody, what does that mean? Because I didn't know anything about stocks. I said, well, the stock went up 1 point today. And well, what does that mean? He said, you would have made $100. And I go, wow, I'm in. How do I do this? Without working, I make $100 in 1962, which is a huge amount of money. And it looked like all you had to do was guess, will it go up or down? Well, ultimately, we do that, except we try to use things like technical or fundamental analysis, something that gives us an edge, that gives us a bit of a bias as to what should take place in the market. Some of us are better at that than others. Some tools are better than others, and sometimes we're not lucky, and sometimes we are.
So what do you think are the best tools to help us develop an edge?
Well, I think the way I look at tools a little differently. I think that you have to break your tools down, and you have to have some tools that set up a market to move. So that's essentially fundamental in nature. I think markets go from A to B because of real reasons, fundamentals, but they dance around because of technical stuff, the emotions of the marketplace. So for setup tools, you mentioned Commitment Trader report earlier. Great report. Yeah, that gives us a real bias, longer term bias in the marketplace. Valuation measures give us a real insight into this market should rally. Those fundamental or conditional setup indicators aren't timing, though. They just say this market should move. It doesn't say when. Then you can bring in the technical tools. And most people just get into technical tools. So to them, a buy signal is a buy signal. To me, a crossing of moving averages, it's only important if it takes place when the market is conditioned to rally. So it's really a combination of tools as to what the best fundamental tools probably for futures be Commitment Trade Report, valuation, and in terms of timing, simple trendline breakouts, channel breakouts is really simple. I think those are the simplest and probably the easiest to actually use.
So trendline breakouts, channel breakouts, but within the realm of the other things lining up as well.
Exactly. And that's where people get confused. They just take a channel breakout, trendline breakout, whatever, not realizing what's the context of this? What's happening underneath this market? Is there a premium in the market? It's wildly bullish if there's a premium in a commodity market. So, yeah.
Sorry, tell us real quick what a premium in the commodity market means.
Well, a premium would be typically, say in wheat or any natural resource market, the nearby contract will sell for a different value than the future contract because the guy out in the future has interest storage costs. So typically the distant contracts will sell for more. That's a standard carrying charge market. Now, when that gets inverted and the nearby sells for more than the distance, that's a premium. That happens because only one reason: somebody wants the nearby contract so intently, they're willing to pay more for it than they usually did. So it's not, speculators don't do that. Little guys don't do that. Funds don't do that. Commercials, the users and producers of the commodity drive it to a premium. They're the controlling factor of the market. So if they're that bullish on the market, yeah, the market's bullish. Buy signals work a lot better.
So when there's a premium in the front months, that's a bullish signal because it
That's
really
really,
means there's a shortage.
it means a shortage, or they, for whatever reason, the commercials want the product. It's important that we notice when the premium comes on, it'll build and it'll go from negative to positive. That's usually a really good buy point to get in. Just the fact there is a premium may have been there for 6 months. So you still have to look at, is the premium fading? Is it building up? But it's a great fundamental tool that most people aren't aware of. It's like, yeah, this is the reality of the marketplace. Somebody wants this so badly, the commercials, they're willing to pay more for it than they usually do. Things like that, I think, are what make technical analysis tools work.
I like it. So, just selfishly, I'd like to dig a little bit into your reads on the COT report, which I know you've done a lot of work on because I use this extensively. And so I know some of the strengths and some of the weaknesses. And, for example, okay, you have the commitments to trade report. And as you know, now they break this report up into all kinds of different things. Whereas before they had this legacy report, and now they have all kinds of disaggregated numbers and all that. What do you think about that? Do you stick with the old report, or do you look at the new stuff? Or I personally stick with the old report because I've tested the new stuff and it hasn't tested as well. But that's just me.
Same answer. I was first introduced to the commitment trade report way back in the 1970s by a guy who had been a member of the Board of Trade Bill, me. And back then we got it on a monthly basis. It was mailed to us, second class mail. So we got about a month after the month it was delayed. But still the legacy report, the old fashioned report, is what I use. I think it's held up the most. And there are some subtle differences. As an example, as you're probably well aware, in the meat markets, there are a lot of small producers that don't do 100 contracts, so they're not as a commercial, but they still understand the market. So in the meat markets, the small traders are really good, whereas in most of the markets, the small traders are not that good. So you have to understand the market a little bit, and also realize the commercials build the position. And they accumulate and distribute. They don't try to buy the absolute low of the marketplace. So it's not a timing tool. People get mixed up with the timing tool. To me, the most interesting one is the large traders, because it looks like they cannot possibly make money in almost every market, almost all the time. The large traders are heavily long at a market top, heavily short at a market bottom. But what people don't understand, they're primarily trend followers. So if a market moves up, they'll buy 100 contracts. It moves up another 50 contracts, another 50. So at the end of a move, they have a large contract, but their basic cost is a lot lower than where they start to get out of it. So you have to think about what's the reality of the marketplace. Like any of this, you just can't take a number and say, oh, this means something. You need let's think about this a little bit. This is still a thinking person's business.
Yeah, I think that's an important point. With the large speculator thing, I mean, the way I always try to explain that is that large speculators are trend followers. They are essentially making markets to the commercials who are hedging. There should over time be a cost to hedging. And so the large speculators are taking on that cost and therefore getting paid for it over time. And that's what trend following to me is, right? Mm-hmm. Except, which is where I play, when they get massively one-sided, right? And I believe that then skews the risk reward of a market. I don't think that it necessarily is going to predict it, but I think when the large speculators get massively long, should you get a reversal and they all have to pile out, there's good risk reward to that trade. That's really how I do my thing. So it's good to hear you say that about the large speculators, and people get, I think, confused with that. You know, they think, oh, look, the large speculators are so long, that means the market's going to turn. Well, no, not necessarily. You know, is always my point.
And it does get into timing. I think what we need to really understand about the large speculators is they get so massively long, they don't have any more money to buy anymore.
That's it.
And that's when I go, okay, now we can bring in a public sentiment, small speculator sentiment, seasonality, a host of other tools. But to me, all these are just one tool. I like to see 4 or 5 set up conditional tools to be there to say, yeah, this market probably is going to rally. Now, gold's a good example right now, where we see the commercials have been short, the large traders long. Crude oil, exactly opposite scenario. The commercials have been long, and large traders have been not buying the market. So I really look for those setups, and then you bring in the typical technical tools.
So you have the setup, and then you're using technicals as the entry. Some form of technical, some sort of breakout, some sort of moving average cross, some sort of whatever. Right. So you got the setup, and then you got what I like to call the confirmation.
Right. Yeah. That is confirming that there's some type of a trend change has taken place. So probably this move is underway, the move we've been looking for based on the fundamental analysis. And then, the market's rallying is probably, the horse is out of the barn. He's going to run now. Left top aboard.
Right. Yeah, that's pretty similar to how I like to look at it. I don't really use technicals. I use more market sort of tone type of thing, but it's the same type of thing. It doesn't really matter what you use, but that's the same type of thing. So how do you handle things on the commitments of traders? Like, what's the look back period? You know what I mean? We have that problem, right? With the commitments of traders, right? So, okay, yes, commercials are super long here, but as compared to what? 6 months, 1 year, 3 years. I believe that in your book, you mentioned 3 years, but how do you feel about that whole problem?
When the 1970s and 80s and 90s, we did use a 3-year look back, worked pretty well then. But with the internet and more, when I first started trading, like 30,000 people traded commodities. Now there's millions trading them. So the pace of the market has really picked up. So I do use a different setback. But more important, and I think really simple for people to follow, this is what I just love in the Commitment Trade Report, to overlay the actual net long, net short position of the commercials and small speculators and the large traders with open interest. And then you understand open interest. Typically, almost all major market highs have a large high open interest. And so if there's a large high open interest, then I go, well, okay, who's driving the open interest to be high? If it's the small speculators, well, yeah, we're at the top. If it's the commercials driving the open interest, no, we're not at the top. So by ripping that apart and looking at who's driving this market, who's in control now, I think we had a great insight. So look back periods, they're nice, but I think really I get a lot more information out of looking at total open interest and then seeing who's driving that market, right? Who's driving the open interest? Open interest is just interest in the market. And then who's really the interested party here? I think that's the best answer.
Interesting. So overlaying open interest while you're looking at the commitments of traders and stuff.
Oh, it's really, really good. And to keep in mind, almost all major highs have been with large high open interest. Not all, there's no be all one rule for everything, but you see a real high level of open interest. You better be very cautious and then see who's driving open interest. The large traders are usually wrong, small speculators are usually wrong, or the commercials.
Yes. The thing about the meat markets is very interesting to me and something that I never thought of before. But it's funny because I often see that the commercials and the small speculators are on the same side. But what you're telling me is that's because a lot of those small speculators are actually just small commercials that don't have to report or they don't report as a.
Yeah, you have to do, if you trade 100 contracts or more, you have to report. So I have a lot of friends here in Montana that are what we'd call very informed. We run 100 cattle on our place here in Montana. A guy does on our property, and he understands the cattle market really well, but he's not a commercial. But he acts as though he is a commercial. He just isn't in the same volume. And same thing, I've got guys that raise hogs, same thing. They understand the market. So for the meat markets, you have to look at that a little differently. And where I learned that was just looking at the data, saying, gee, for years, the small specs have been right in this market. So I talked to some of my producers. Well, we can't trade 100 contracts, but we know what we're doing.
Right. That makes a lot of sense. Do you think that's also true in some of the other markets, maybe some of the agricultural markets, small farmers, or?
Yeah, it's more true. It's been more consistent in the meat markets. That's where it's really been the best.
That's a great piece of information that somebody that's from New Jersey and not Montana would not know about. And so that's just, that right there is awesome for me, because the meat markets yeah, they always have this thing to me where like I can't trade it because the small specs are lined up. I like to fade the small specs, but
Not in the meat markets. No.
yeah, no, that makes a ton of sense. I appreciate that. That's a great piece of information. Somebody was saying that you have a COT proxy for individual stocks.
Yes,
How's that work?
really well.
I mean, how do you do it?
Well, because I was the first person to write about the COT reports way back in the 1970s. Nobody followed it. No one knew what it was. I've watched this year in and year out for 50 some years now. So I think I understand how the commercials buy. And with that knowledge, I can duplicate pretty much their buying in a commodity market. So I figure, well, if I can understand how they buy in commodities, that should apply to stocks as well. So it's just a model of how professional large funds perhaps buy. And so this model will tell me when they're aggressively on the long side or aggressively on the short side. That's really interesting. I developed this, 20 some years ago now, I guess, more than that, maybe almost 30 years ago. And it still almost exactly parallels the actual COT index. So we just understand, and the basics is they buy weakness and the public buy strength. So it's understanding how they buy the weakness that gives us a pretty good idea. And when it transfers to stocks, it's the same thing. It's not a perfect tool, but it's a really good setup tool. Says, yeah, there's been a lot of informed buying in this market now, and this stock should rally.
So wouldn't that get you run over in a trending stock market? I mean, in other words, if you're making the assumption that, okay, the commercials are buying weakness and selling strength, which we know they do in the commodities, we see that consistently. Take, of course, NVIDIA the last couple of years. If you were assuming that the commercials were selling that strength and you were looking to short that stock, you would have gotten run over.
No.
Because, I mean, other than risk management and waiting for confirmation,
Well,
you wouldn't have gotten that stuff.
Well, then that's where we can bring a few other things in. I don't have my data. Maybe I can bring up my chart right now and look at them on another screen here and see. But if I look at what was happening in NVIDIA, we got a really good sell signals based on cycles right at the high. 2 days from the high, went on Mad Money show. Jim Cramer said this is the high, and then it's going to rally later on, which is now starting to happen. So you can use other timing tools, but I'm pretty certain that let's see if I can bring this up, and I can tell you what the synthetic index for commercials did. And it actually showed a lot of heavy buying. It was in a sell 1 week from the high. Finally, the COT synthetic version, if you will, gave a sell signal, and then they were heavy accumulators in the middle of July, and right now they're neither bullish nor bearish. So the last time they were really bullish was just the end of July, and they've been very bearish 1 week from the absolute high of the marketplace. So, and they'd been.
This is using then maybe, I'm just guessing here, but
Sure. Mm-hmm.
Sort of insiders as the commercials. Is that what is that like insider selling? Because I know there's been quite a bit of selling.
Yeah, you could call it that. I mean, I just think that funds. I mean, I know guys that manage billions of dollars. I know how they buy, and
Right.
so if I can break down the close to close, there's actually 28 relationships between yesterday's open high low close and today's open high low close, and those are caused by people buying and selling. So I can understand which ones of those are the most important. Then I get a sense of who's been a buyer or a seller today. And clearly, I think you can break down one of my tools I use that we call Progo, which is professional buyers, and then public buyers. And it's really interesting. You look at a chart of it, yeah, the professionals, when they're more professional buying than public buying, markets rally. And when there's more public buying than professional buying, markets decline. And so it's just understanding how these people buy and sell. And it's again, it's just a tool. there's no one be all end all stuff for these markets, though I wish there was. Probably like you, we beat our heads against the wall to find it, but 62 years of this, I haven't found it. I don't know if that has found it. And I know a lot of people. No, it doesn't. It doesn't. But what does exist is the ability to be smarter than the other guy. That gives us an awesome advantage if we can get a sense of where the bias is in the marketplace. Then we're, in the land of the kingdom, one-eyed man is land of the blind, one-eyed man is king. And
yes,
that's what I'm looking for. Better vision.
I'm literally the one-eyed man, so I appreciate that comment. I only have one eye that works. What are these type of indicators that you're talking about, like this proxy COT for individuals? Are those available to the public? Can we get those somewhere?
Yeah, we do have them available in TradeStation, Bloomberg, NinjaTrader, StockCharts.com, and Tom DeMark's new charting service, Symbolic. I say maybe one other place, but yeah, they are available if people want them. And then I occasionally, I don't have it anymore because I'm trying to retire. I would give classes and then would teach the people how to use the indicators in the classes. But at this point, I turned 82 a few days ago, and
Happy birthday.
Thank you. I am walking off the stage while I'm alive. I saw Muhammad Ali lose his last fight. I saw so many people that were so good, and Tom Brady, and they should have quit when they're ahead. And I've had a great run in the market. You know what? I really want to continue, but I'm going to walk off the stage while I can walk and not be like Joe Biden and other people leaving the stage.
Yeah, I say that every day. I'm only 57, but I keep saying that to myself too, but somehow I keep coming back,
Well, I did that for
just
long,
when I think I'm
time.
out,
Yeah, but I finally, I'm 82. What, I have another 10, 12 good years left. Do I want to spend 12 years just looking at things bounce up and down on a screen?
Yeah, no, I hear you. Believe me. I mean, I'm looking at you at 82 and I look at me at 57. I ain't making it to 82. So.
Yeah, you can. You got to do things right. There's a lot of stuff you can do. Yeah. And that's been a fascination of mine, is how to live better, how to live longer so you can trade more. I see so many people become really successful trading, and that's great. But the other side of that is they eat too much, they drink too much, they don't exercise, they get fat, they get overweight, they get arthritis, and they don't have a happy life. I go, hey, you know what? I'm not doing that. I went to a doctor when I was maybe 35 years old, something like 30. Barney Meltzer in San Diego. And he said, Larry, he said, you're a stock trader. I said, yeah. He said, look, this is your health. You're overweight right now. I weigh 225 pounds. Your curve is going down. He said, if a stock is going down like that, it's probably not going to turn around. It's going to go down. You can't get out of that. You got to break that curve now and bring it up, because with your health, if it's down that much, you can't bring it up. And I see people my age. I say, you know what? I say that your age, yeah, you can still turn that curve around. But you get to a point, it's too difficult to do it.
I may have reached that point early, but I appreciate the words, because it's motivational, because yes, I do. I need to turn it around. That's for damn sure. So I keep thinking getting out of trading will help me turn that around, because it'll be able to focus my time on that. But it's a whole nother conversation.
Well, you can do both. You can still exercise and do walking, whatever. There's a great study that says that people live longer than people that don't walk. This is a really interesting part of it, though. People that walk fast live longer than people that just walk. So if you walk fast for 15, 20 minutes a day, you're way ahead of the pack. That's some 15 minutes. You can take that anytime you want to.
Anytime
even as a day trader. And he's a day trader. Yeah.
I'm not even a day trader. So good. Yeah, I can do that anytime I want to. And I'm writing it down on my list right now. Walk fast 15 minutes a day. I'm just curious, can you smoke a cigarette while you're walking fast?
Oh, my good friend, Ralph Vince. You probably know who Ralph is, right? Mr. Money Management. Ralph worked with me for a long time. We ran marathon together. When he first started, his wife would come out at mile 18 and give him a cigarette, because he was a smoking runner. That was great. I mean, some of us will have a margarita along the way, right? Yeah. But he would have, so you can run and smoke, but I don't think you want to continue that as a lifestyle. Ralph no longer smokes, by the way.
That's classic. I would
Yeah,
love to see
only round,
somebody
only
running a
round.
marathon with a cigarette in their mouth. That would be my
Oh,
idol.
well, you know what I used to do when I went there, did Boston Marathon 3 or 4 times, and you take buses out to the start. I had one of these fake cigarettes you blow out and it looks like smoke comes out of it.
Right.
So you get in the marathon bus with this thing, puff on it, smoke comes out, they go crazy.
Oh,
No
yeah.
smoking, no smoke. They're all like fine-tuned athletes, right?
Yeah,
Like,
right.
it's just a joke, but oh man, people get really hyper about that.
Yeah, I'm sure they do. So let's talk a little about the psychoanalysis stuff. This is something I don't do, something I don't know a lot about, but I know you do pretty extensively, and I'd love to hear about it.
It's been something I've been in pursuit of since I first began in the markets in 1962. I began, and then we had a bottom in 1966. And I thought that's interesting because I went back 4 years from 1962. We had a bottom in 1958. I noticed we were really consistent bottoming about every 4 years in the stock market. And then I read a book by Edgar Lawrence Smith called Tides in the Affairs of Mankind. And
Sorry, what was that called?
Edgar Lawrence Smith, and
Edgar
it's called
Lawrence Smith.
Tide in the Affairs of Mankind. This guy just nailed it. Oh my gosh. I wish I would have listened to his book when I first read it in the 60s. Warren Buffett said he's one of the smartest men he's ever known. He actually changed. Back in the 30s, people thought that bonds outperformed stocks. That was the message of the day. Well, Edgar Lawrence Smith turned that around and said, no, that's wrong. And here's why. And his research is what propelled Buffett to do what Buffett does. And Buffett acknowledges them. So I really like, and he got into cycles. And the only thing is, yeah, cycles exist. Why? That's perplexes me. And they shift and they change. But there's been a couple of cycles that have been really consistent over the years. That W.D. Gann did some cycle work. Parnell McKenna did. It's been around. Fortunately, there's a piece of trading software I use called Timing Solutions. I don't get anything for talking about it. I just use it. It allows you to do so much stuff that we couldn't do before. And so that's been very helpful. And then trying to formulate, well, what is the cause of these cycles? Is it solar? No, it isn't solar. I thought for sure the 11-year solar cycle would be it. Well, it isn't. And some stocks have a little different cycle than others, but I've been trying to ferret out what these things are. And most of my forecasts have been pretty good, a year in advance. I got an email today or yesterday from a guy who said, hey, I made a fortune with your NASDAQ forecast this year. Thank you, Larry. I mean, it's not an unusual occurrence. They're not always perfect, but boy, there's been some that we just nailed markets. So I know there's some force at work here. And I'm tempted to think that news and fundamentals and all that kind of don't matter. They drive the extension of the move, but things are going to happen regardless of who's in office, if it's Donald Trump or Kamala or whoever it is. These things are going to happen, and we're pretending. I think that there's destiny to markets. And of course, that flies in the face of all the university people who say you can't predict the markets. But I do believe, and I've been doing my forecast reports now for, 20 years, something like that.
And those are available to us as well?
Yeah, at the end of the year, we'll announce it when it's ready.
But is there a website that you have where people can follow your stuff long term or not?
Yeah, there is. It's ireallytrade.com.
Sorry, say again?
ireallytrade.com.
ireallytrade.com. Okay.
Because I really trade. And last year, our headline for report was bull market. We're going to be a big bull market. And that's been true.
Yeah, no, I believe very much in your statement of what you said, that the markets are going to go where the markets are going to go, and all this other stuff is just noise. It may affect the path of where it's going to go. And I see this with all of my trades. I never really, even the ones at work, I don't know what the path is going to be. And the path gets affected by various news events that come out, long oil or whatever in the Middle East happens, or an inventory report happens, and the path is different, but ultimately it's going to go where it's going to go. I believe very strongly in that.
There's a great song that Lauren Green, remember Lauren Green from Bonanza, Cartwright, the Bonanza television show? And if you're maybe too young for that.
I'm a little too young for that one.
Well, Bonanza was a big
Which
TV
I rarely
show.
get to say anymore, but go ahead.
Well, there's a great song about the graves of destiny where this cowboy comes into town, he digs 3 graves, and somebody said, what are you digging graves for? I said, well, I found my wife's been cheating on me. I'm going to go kill her lover, and then kill myself. So he goes downtown. He sees the wife with the lover, and he just can't do it. A bank robbery breaks out at that time. There's a lot of shooting going on, and the robbers unintentionally shoot the guy, the girl, and the lover, and so they're all buried in the graves of destiny. They were going to die anyway. Didn't matter. So this, I think there is some. Last year, I'm just reading it right now. This is written in December last year. In a nutshell, 2024 we'll see higher stock prices. Be bullish or be out remains my mantra. So consider how many people were horribly negative in the market last year. We can get a pretty good idea of what's going to happen. Precise, exactly, no, but the bias of the marketplace, which I'm looking for. Do I have an advantage here? It's like if you're going to play blackjack near a card counter, you know when the deck is rich. And the same thing here. I want to know when the deck is rich to be bullish or be out.
So you have this cycle analysis. It does a pretty long-term thing, like a year out or whatever. Mm-hmm. But will this change as the year goes on, as some of these other things, such as COT and positioning and psychology, change?
No.
So regardless of the positioning and all that, if this is what the cycle is, this is what the cycle is.
The cycle, what the ones I'm working with are pretty basic, pretty long term. The shorter term cycles, they'll fluctuate, they'll come in and out, but basically, no, the path is there. And like you pointed out, which is exactly correct, the news of the day will make it oscillate more or less, but the basic path is there.
Okay, because for me, I would probably change as the positioning changes, because I'm such a big believer in positioning, and it drives my stuff, So for me, at least, I would probably start to change my view. Now, it hasn't happened in the stock market, by the way. So the cycle is free to continue, But let's just say I had something that told me the stock market was going to close at the highs this year, but then suddenly everyone got massively long on the commitments of traders. I would start to think of a change personally, but that doesn't seem to be your thing.
Well, no, I still want to look at the fundamentals of what's going on, but in the context of and this is where people get mixed up with cycles. Really important point. I'm glad you brought that up for me to make. Cycles are about time. They're not about magnitude. So what you mentioned, the COT report changes. That's the magnitude of the move. But people see my charts was ups and downs. No, cycles simply measure time. They don't measure magnitude. They tell us this is a time to be bullish. This is a time to be bearish. The magnitude of the move comes from exactly what you talked about, Jason. What's the fundamental condition of the marketplace when we first started talking the show? That's what drives the magnitude. Cycles are just about timing. That's all.
That's great. That's important. Cool. Here's a question somebody asked, which actually ties right into what I was just saying. But in an interview in May this year, Larry was bearish Bitcoin based on his cycle analysis. I wonder what his latest thoughts are on Bitcoin, especially given the now crowded COT positioning. It's funny that's the question that came up right after I just asked that, but yeah.
Well, it depends on what Bitcoin we're going to look at. Again, I was on the Mad Money show, I think with Mad Money, with Bitcoin on coin, the stock coin, and very negative on that. And of course, it crashed. And in fact, what I'm going to do while we're talking about this, I'm going to bring up Bitcoin. I'll bring up GBTC. And we'll just look at what cycle are telling us right here, right now about it, so we can bring that up to date. I don't follow Bitcoin. I'm an old man. I think this is the biggest scam in the world. They're going to give me a Bitcoin, but they want my dollars. I go, wait a minute, what's going on here? Like, that's kind of interesting, isn't it?
Well, do you believe, on that note, do you believe, and what do you think about the whole concept of what the bears love? Okay. The government's borrowing too much. The fiat currency is a Ponzi scheme game. And that has to, not necessarily today, but that has to come to an end at some level, blah, blah, blah. I mean, this is really the ultimate Bitcoiner bull story, right? It's hard to deny some of these things. I don't know if that leads to Bitcoin, because the government probably, or at least maybe, wouldn't allow that to happen. But what do you think of that whole fundamental story? And I know I always say it, we've been hearing this since the 80s, since Reagan. And if you were bearish since the 80s because of too much debt, you've you're dead. And you missed out on making a lot of money. But
let me first give the Bitcoin thing, and then I'll answer that question. Okay. So my Bitcoin forecast was turned negative the middle of April. Says the rally we've been in now is about through. We should come down to the 1st of November, rally up, but the best buy point comes in April of next year. So I continue to see this market at a down pattern. So we're
looking towards April on a psychoanalysis.
I think the next best time to buy is going to be April. Yeah. And again, it's been a great trading vehicle. I haven't traded it. I see it as a trading vehicle, but right now we should start to decline until November, a little rally up, and then in December come back down again. Now, to answer your bigger question, which is, see, this is the nice thing of there's not a lot of nice things about getting old, but what you just mentioned about, well, since Reagan, we've had deficits. Hey, Jason, let's go back to when I started in 1962.
No, that's right. You can go back.
And there were guys in the brokerage room. Oh, those deficits are going to kill us. Yeah. And I believe that. I kept waiting for the crash of 1929.
Right.
I waited in the 60s, the 70s, 80s, the 90s, 2000. What hasn't happened?
Right.
So it
did once.
When?
Oh, wait.
No, that was nothing. Go back to the bear market in 1970. That was a real bear market. A couple of years. 2008 was over in a year.
No, that's right.
Boom, we're back up. Yeah. Like, wait, that was not a bear market. That was a piece of chocolate compared to 1970. Yeah. It really was. So, but this is the way I see things is so upside down. If you want to stop inflation, don't have high interest rates. High interest rates cause inflation because there's more money in circulation. Who's the largest player of interest rates? The United States government. So if interest rates are higher, there's more money in circulation. That's one of the reasons that we have inflation. In terms of the deficit, when I ran for the U.S. Senate here in Montana, I was conservative, but still am. But I thought that deficits really matter. We need a balanced budget and all that. When I moved to the Virgin Islands, Warren Mosler became a good friend of mine. Warren is a proponent of the modern monetary theory. And I listened to Warren, I couldn't understand it. Finally, I realized, wait, we're not on a gold-backed currency. We're on a fiat currency. And in fact, deficits are really bullish. The larger the deficit, the bigger the stock market rally. And it makes sense because there's more money in circulation for people to buy stuff and companies to expand and do research and build. So this whole idea of deficits are going to kill us, I can't agree with that. And
it's all, in other words, a liquidity game. The more liquidity, the more assets can go up. I mean, this is Milton Friedman stuff.
Yeah, there's liquidity to the markets, and deficits provide more fuel. The problem, ultimately, and even Warren will admit this, at some point, you may start to get really rampant runaway inflation, and the modern monetary theory reply to that is increase taxes because that really kills the economy. So that's what they would do. But I think that the
well, if they do that, then I hope that there's a lot near you because I'm coming.
Well, come to the Virgin Islands because the Virgin Islands have the greatest tax program in the world.
No, that's what I'm saying. If they raise taxes, I just got done with my accountant yesterday. If they raise taxes again, I'm coming. I can't take it anymore.
In the Virgin Islands, which is a U.S. territory, if you qualify for their economic development program, which isn't that hard to do, your effective state and federal tax is 3.9%, not 30%, 3.9%. So that's why so many traders are there and other businesses. The economic development program, the Virgin Islands, Puerto Rico has the same thing.
Yeah.
It's a great tax advantage to be there.
Yeah. Well, that's it. But don't you think my whole thing is, I agree with all that. I've been a proponent of all that. My whole point is a Ponzi scheme blows up when it runs out of money. These people don't run out of money because they control the money. They print the money, right? So there is no running out. So I get that idea. The more the deficit is, the more they've got to print, the more they've got to do. And that is just more money going in. And that's very bullish assets. Yes.
Yeah.
But is there not a limit to everything in the world, including how much money the United States can print? I mean, doesn't physics teach us there's a limit at some point? And I'm not saying we're there. I'm not saying we're close to there. I have no idea where it would be. But is there not a limit somewhere to what they can print before people just say, I don't want these things anymore? We go Zimbabwe.
Well, let's look at the Bitcoin crowd. We could ask them that same question.
Yes.
They're creating artificial coin, currency, whatever this stuff is, unlimited. You and I can throw, oh, we have the great coin and you should buy it because it's scarce. Like, what? Yes, to answer the question, there is a point when there can be too much. I don't know where that point is.
No one does.
It probably has a percent of the GNP or percent of that's the one I look at the most. But
we don't even know what percentage that would even be.
Right. And again, going back to the beautiful point you made earlier, when you started in 1980, you heard the deficits were going to kill us. When I started in 1962, the deficits were going to kill us. They've gotten bigger and bigger and bigger.
Yes.
But the economy's gotten bigger. Look at GDP now versus where it was in 1962, 1982, 1992. Yeah. So we have, I think one of the things where people get economics wrong, they think it's a pie that's just this big, and it never. But it's an expansive pie. It gets bigger and bigger. So you take a slice. There's plenty of pie left for me. People don't understand that this economy is an expansive economy. It's not just limited to we only all get just one little slice of pie.
Yeah, and I guess like you say, if it ever gets to that point, they'll just raise taxes. And they'll slow the whole freaking thing down.
If we get to that point, my cycles will tell us first. That's what.
There we go. All right, good. Couple more things these people asked that go back a little bit in the conversation. But as far as trading stuff goes, how do you deal with sizing? How do you deal with stop losses? How do you deal with exiting a trade? How do you approach that type of stuff?
Well, that's obviously some of my weaker points. So thanks for bringing those things up. I can relearn. Well, in terms of sizing, I only want to risk a certain percentage of my portfolio.
But how do you decide that? Are you sizing that to a stop loss or like?
No, I mean, if you read Ralph Vince's work, there is an optimal amount of money that you should have on every trade. But I found that that's way too risky for me.
Right.
The point that people get messed up on money management is it's really not managing your account. Money management is emotional management. I can take a loss. I have the emotions for that. I've been trading a long time. A lot of people can't do that, right? So you have to say, well, yeah, at this point, this is my emotional cutoff. Maybe it's $1,000, $500, but you have to manage. If you can't manage your emotions, you can't manage your money. So the first thing is, where's your emotional quotient? You have to figure that out. Then you can go into standard money management. By and large, 4% risk of your portfolio is pretty large for most people, and it can be very productive. So it just depends a little bit on your emotions, but I wouldn't want to risk more than 4% of an account on any given trade. And so then let's say you've got a $100,000 account, you're going to risk $4,000. So if my stop was $4,000 away, I can buy one contract. If my stop was $8,000 away, I can't take the trade.
Right.
So
you're basically like off of your stop. This is where I'm going to get stopped out. Therefore, I know I'm going to lose this much if I lose. Therefore, this is how much I'm going to put on.
How many contracts?
$4,000 stop loss. Yeah, that's exactly how I do it. What about taking profits? Is it based on your cycle stuff? Like, okay, this is an end, so I'm getting out.
This is my really weak point. I'm just too damn greedy.
Yeah,
just like everybody else. I've used some of Tom DeMarc's work and targets have been really helpful for me because I tend to overstay my positions. I do like to use a trailing stop.
What did you say, Tom DeMarc's work?
Yeah. Tom's got some great stuff on where prices should go. I've never been really good at predicting where they should go. I've been more time oriented, I guess. But trailing stops because maybe I don't get to my target. I do have targets that I like and they've been consistently good. But we may not get there, so then I use a trailing stop as well.
Which, trailing, so it'll adjust as time goes on.
Yeah, and as the market moves, then my stop will get raised up to different places.
Right. So you're a trailing stop guy.
Yeah, trailing stops and targets. I do have targets up there someplace, and it's frustrating. Like I've been along crude oil in here, had a nice run up, I didn't get out. Well, it's finally coming back today a little bit. It's just the frustration of living through that. But I know this. I don't know how many trades I've had in my life, millions.
Okay.
I got in at the low of one market one time and the high of a market one time. And you'd think the odds I should have done more than that, right, Jason? But I couldn't. I didn't. And
not if that's your trading style. I mean, unless you're really super counter trend trader, to buy the lows and sell the highs is really not a thing.
Yeah, but that's what everybody wants to do. And so I realized, look, this is going to happen. I'm going to get beat up. I'm not going to get high and low. So if I had a target and the market goes higher, well, God bless whoever's writing it higher. And if it doesn't hit my target, then I have protective stop underneath the market where my stop will be. So I'm hopeful it'll capture some of the profit in the trade.
And again, it's primarily based, like, why did you buy crude? Because of the cycle stuff, or?
Yeah, well, because there's fundamental setup condition, and then there's a trend change in favor of that condition.
Right.
That we're looking for.
Gotcha. I'm going to ask you one more question from these guys, and then I'm going to ask you my questions, and then we'll be done. Can you ask him the strategy he used to win the World Cup Futures Championship?
Sure, real easy strategy called volatility breakout. Back then, we had pit sessions market, unlike today.
Mm-hmm.
And if the market opened, we would add a value to the opening and be a buyer there. Subtract a value from the opening, would be a seller there. And it was a great technique. I taught it. A lot of people made millions of dollars trading it. Became very, very popular. And then we went into the stupid night sessions, and it doesn't work anymore.
So it was a vol breakout system.
A volatility
sort of
breakout,
a trend following system type thing.
We didn't really have a name for it. Eventually, and a guy named Doug Bree, I think, or Breesy, not Breesy, Doug, I think his name in a moment, put the right label on it, a label called volatility breakout. But we'd been doing that. Ralph Vince and I started doing that in 1987 and just 86, and set the world on fire with our performance. It was incredible performance. And with very aggressive money management, way too aggressive. We're a young kid.
Well, of course.
What do we know, right? We didn't know what we were doing. But yeah, it worked really well. But it isn't as effective now because we have the night session opening, and the day session openings they have to change the whole thing.
It's already gone. Yeah. Awesome. So tell me, where's Spoos going? And I'm not serious about that exact question, but in general, what's your stuff saying about different things? Anything big? Your bullish stocks. The cycle is bullish stocks.
You want to buy stocks just before the election. You want to be long at the end of this month, for sure.
And that's going into year end, or?
And I think this coming year will be on the long side. You want to be on the long side of the market
for the rest of this year
and next year.
Okay, so the bull market continues, which makes total sense to me. Anything else? You're saying that oil, was that a major low in oil here recently, or is that just a trading low, or?
Pretty important.
And obviously, I'm not going to hold you to any of this. Let's all know that no matter who you are, we get things wrong. You know what I mean? Don't be coming back and saying, Larry Williams got this wrong. You know what I mean?
I have
Larry Williams will be the first person to admit he gets things wrong, and I'll be the second person to admit I get things wrong. But we're traders. But anyway.
I think the good trades here to be long the energy markets probably as a very short-term trader until the middle of this month. And then probably you'll see a pullback and go higher again. I think the metal markets are at a significant high in here, and so
I think the metal markets are at a significant high in here.
Yeah, absolutely. Yeah. So I want to work the short side of that market. Those to me.
Does that mean we should also be long dollar?
You took the words out of my mouth. Yeah, man, this is a trade I really screwed up. So it's easier to sell the euro currency than to buy the dollar. And I tried to sell it, got stopped that once. Then I didn't get in it again. It's collapsed, and I'm not in the trade. As a perfect Larry Williams trade, I'm not in it. So
this is what my portfolio amazingly looks like. So anything else that you're saying? We already talked about Bitcoin. We talked stocks are going up. Dollars probably going up and metals down. Energy probably up. Any view on the grains? Grains have been pretty crazy.
I haven't really, because I'm trying to phase out and retire, I haven't looked at the grains.
Right.
I really haven't, it's been summertime and in Montana, and we went to the Olympics in Paris this year.
Nice.
So I'm just I'm trying to pull back and not be so focused. I'm just focused on the bond market, the energy markets, metal markets, and really focus on those. I think that's one thing I can do. Now I don't have to report to everybody in every market. Like, I can just focus on where I think the best opportunities are.
Which I guess we just spoke about, which amazingly is very similar to what my portfolio is looking like. So I hope you're right. It sounds like maybe I have some good odds on my side. Well, that's excellent, Larry. I really, anything else you want to say? Is there a place people should go to find that if you want to be found, where they should go to find your stuff, or where they can go to find your stuff, or?
Yeah, just ireallytrade.com. We do have a mailing list, and we send out a bunch of free trading lessons. They're pretty good. So if somebody could do that, and I don't know that we'll be doing much in the future other than my annual forecast report. But there's a lot of good stuff there. Like you, we like to produce good stuff for free for people, and I think it's helped. I know it's helped a lot of people, so I enjoy doing that.
Awesome. I really appreciate you taking the time.
My pleasure, Jason.
I think there were some incredibly valuable nuggets in here.
Enjoyed your questions. I think that's what maybe brought out the nuggets. So thank you very much. I enjoyed it.
Yeah, I mean, for somebody that has been using the COT stuff for 25 years, I learned a bunch of stuff just about the COT stuff, which is awesome for me. Great. Thanks so much. I hope we can keep in touch.
I look forward to that.
I wish you continued excellent and interesting life that you've been living. You look great for an 82-year-old guy, man. You look better than I do. That's for damn sure. And God bless and all that stuff.
You as well. Good luck and good trading.
All right. Thanks.
Thanks, Jason.